A Westpac branch can pass for background: glass doors, red lettering, a card tapped at a counter, an app opened without a thought. Yet behind that ordinary name stands the Bank of New South Wales, opened in Sydney in 1817 and identified as Australia's first bank. Its promise was trust, safe deposits, steady branches, loans, savings, and financial confidence. The harder question is what trust becomes when a bank grows into an institution. It becomes access to credit, homes, business survival, debt, and financial authority. This is Australian old money in institutional form, not a family mansion, but ledgers, mortgages, records, and confidence. To understand Westpac, follow the older name it replaced and the power that remained after the sign changed. The ordinary logo with an older power behind it. A bank logo can disappear in plain sight. It sits above a branch door, printed on a card, glowing on a phone screen, folded into the background of ordinary money. People pass it on a lunch break, tap it at a counter, open it on an app, and rarely think about the older world underneath it. Westpac carries that kind of quiet familiarity. Its power does not announce itself like a mine, a railway, a factory, or a family mansion on a hill. It appears in quieter places: a mortgage document, a business account, a savings balance, a loan approval, a branch on a main street. That quietness is part of its strength. Behind the Westpac name sits the Bank of New South Wales, an institution that began long before modern Australia took shape. The modern brand may look corporate and familiar, yet its roots reach back to the earliest formal banking in the colony. Westpac is not simply a bank that became large. It is the surviving face of an older financial institution built around trust, records, credit, and public confidence. That makes this story different from many old money stories. There is no single family dynasty at the center. No inherited pastoral estate explains the whole institution. No private mansion carries the meaning on its own. The old money here is institutional. It was built through deposits people trusted, ledgers clerks maintained, notes people accepted, branches customers entered, loans businesses depended on, and mortgages families carried for years. It worked because people believed the institution would still be there tomorrow. A mining fortune can be seen in the pit. A retail dynasty can be seen in the department store. A brewing family can be seen on the bottle. Banking power is harder to picture because it often lives in permission. Permission to borrow. Permission to expand. Permission to buy a house, survive a bad season, open a shop, or move money from one place to another safely. That kind of power rarely looks dramatic from the street. It can still shape lives more deeply than a louder empire. For ordinary Australians, banks were never abstract for long. They were where wages landed, where savings were protected, where a small business asked for breathing room, where a family tried to turn income into a home. A branch could be part of a town's routine, a marker of seriousness on a city street, or a familiar stop for people who needed someone across the counter, not only a number on a screen. The public image of a bank is stability, safe deposits, steady service. A place that looks calm even when money outside its walls feels uncertain. The trust that made a bank useful also gave it influence. Once enough people trusted the same institution, that institution became more than a service. It became part of the machinery of Australian life. Westpac's story is not a fall from glory in the usual sense. It is not a ruined factory story, and it should not be told as a collapse. The older Bank of New South Wales name eventually moved out of everyday view, while the institution continued under a new identity. The sign changed. The lineage remained. The meaning became more complex. To understand that shift, the story has to move away from the modern branch and back to a much smaller Sydney, where formal banking was not background noise. It was a new kind of order. Before the glass doors, before the banking app, before the modern corporate name, there was a colony trying to make money reliable, and a bank created because trust had to be built before it could be taken for granted. When Sydney needed a bank before it needed a nation. Before trust could become a logo, it had to become something much harder, a working system. Sydney in 1817 was not the financial capital Australians know today. It was a colonial town trying to organise trade, credit, wages, property, and everyday exchange. Money did not yet carry the quiet certainty it carries in a modern account. The colony needed more than coins changing hands or private promises written on paper. It needed an institution people could recognise, use, and believe in. That is where the Bank of New South Wales entered the story. Its first home was not a glass tower or a grand national headquarters. It opened in rented premises at Macquarie Place, connected to Mary Raybay, one of colonial Sydney's most important businesswomen. That detail matters because it places the beginning of Australian banking in a real street, inside a real commercial world, among people trying to build order out of uncertainty. The bank did not begin as a distant corporate machine. It began in a town where trust had to be practical. Governor Lachlan Macquarie was central to that world. His administration wanted a more orderly colony, and banking fitted that ambition. Judge Advocate John Wilde also matters because the legal side of the colony exposed how unstable money and private financial promises could become a burden. If debts, notes, and payments could not be trusted, then courts, merchants, landholders, workers, and customers all felt the strain in different ways. The early bank was tied to authority from the beginning. It carried the weight of colonial approval, commercial need, and social respectability. That is the first sign of its old money character. Not old money as luxury. Old money as access. Old money as legitimacy. Old money as the ability to stand between people and the uncertainty of the financial world. For the colony's merchants, a bank offered a more reliable way to handle trade and credit. For landholders and business people, it gave money a place to gather and move. For ordinary workers and customers, even indirectly, it helped shape the system through which wages, goods, debts, and savings would eventually pass. The people outside the boardroom may not have controlled the institution, yet they lived inside the economy it helped create. A bank is powerful because it makes promises feel official. That mattered in a young colony where confidence could not be assumed. A private promise might work between two people who knew each other. A bank made the promise wider. It turned trust into something with a counter, a record, a name, a signature, and a place where people could return. In that sense, the Bank of New South Wales was not only serving commerce. It was helping define what reliable money looked like in Australia. Macquarie Place gives the story its physical beginning. The deeper beginning was the need for confidence. Before the old records, before the later branches, before the Westpac name, the first pressure was basic. People needed a way to believe that value could be stored, transferred, borrowed, and repaid. That belief would later become ordinary. In 1817, it still had to be built. The early figures around the bank also show why this was never a simple family dynasty. The story involved colonial officials, legal authority, Sydney traders, merchants, shareholders, and business interests. Power came through a network, not through one inherited family line. That network gave the bank a place inside the commercial establishment of New South Wales. The influence was formal, practical, and visible to those who needed credit. A pastoral fortune might begin with land. A mining fortune might begin with a seam of ore. A retail fortune might begin with a shopfront. This banking power began with trust made official. It was built through permission, confidence, and records. The people who controlled those records held something more durable than a single product. They held a place in the structure of exchange itself. From the street, the first bank may not have looked like the beginning of a national institution. It was a small beginning in a colonial town, shaped by local pressures and official ambition. The conditions around it made the story larger than its first rooms. Sydney needed money that could be trusted. Merchants needed credit that could travel beyond private relationships. The colony needed a financial centre of gravity. Once the bank opened its doors, the question changed. New South Wales no longer only needed a bank in theory. It had one in practice. Now trust had to become usable, something people could hold, sign, deposit, lend, record, and pass from one hand to another. That next step gave the institution its first real instruments of power: paper, ink, records, and the quiet authority of a promise written down. The first notes, ledgers, and the making of trust. The first real power of the bank was not locked in a vault. It was written on paper. A note, a ledger, a name entered carefully into a book, a promise made visible in ink. In a colony where confidence still had to be built, those objects mattered because they turned uncertain private dealings into something people could recognize and use. Money became more than metal, barter, or personal agreement. It became a record backed by an institution. On the first day the Bank of New South Wales opened, it issued a banknote. That detail carries more weight than it first appears. A banknote is simple to hold, easy to pass across a counter, and ordinary once people accept it. At the beginning, acceptance was the whole question. A piece of paper only works as money when enough people believe the promise behind it. The bank's role was to make that belief feel reliable. That is where institutional power began to take shape. A banknote said that value could travel. A ledger said that value could be remembered. A charter gave the institution standing. A deed gave transactions legal weight. Correspondence connected merchants, directors, customers, and officials across distance. Shareholding records showed who stood behind the institution and who had a stake in its success. None of these objects looked dramatic on their own. Together, they helped create the machinery of trust. For the clerks who wrote the entries, accuracy mattered. A wrong figure, a missed payment, a lost record, or a doubtful promise could damage confidence. The quiet work of banking depended on people whose names rarely become the center of history: clerks, tellers, porters, guards, bookkeepers, and messengers. They did not own the institution. They did not design the larger strategy. The reliability of the bank passed through their hands every day. That is one of the overlooked human layers of financial power. Old money is often imagined through land, houses, portraits, estates, and family names. In banking, old power looked different. It lived in the authority to record what people owed, what they owned, what they deposited, what they borrowed, and what the institution promised to honor. The wealth was not only in the money itself. It was in being trusted to keep the record. The early Bank of New South Wales was surrounded by Sydney's commercial world. Traders, merchants, shareholders, and colonial figures were part of the institution's first circle. Their involvement gave the bank more than capital. It gave it credibility. In a young colony, reputation was not decoration. Reputation was part of the business model. People needed to believe the bank was strong enough, respectable enough, and connected enough to stand behind the paper it issued. That connection between respectability and power is central to the story. The bank did not need to own a vast estate to shape the colony's economy. It did not need a mine, a fleet of ships, or a chain of stores to matter. Its influence came from sitting at the point where money became official. A merchant could use the bank to handle trade. A business could use it to manage payments. A customer could begin to treat paper as dependable because an institution stood behind it. Step by step, trust became a system. The records also created memory. A private deal might disappear when the people involved moved on or died. A bank ledger preserved the transaction. It gave the financial world continuity. That continuity is one reason banking institutions can become so powerful over time. They do not simply handle money in the present. They carry obligations forward. They remember debts. They preserve claims. They make the past part of the future. That kind of memory can feel neutral, almost invisible. It is easy to see a ledger as a dry object, a relic for an archive shelf. Look more closely, and it becomes something more revealing. Every line points to a relationship of trust: someone depositing, someone borrowing, someone paying, someone waiting, someone depending on the promise being honored. The power of the institution came from turning those relationships into orderly records. For ordinary people, that system could bring stability. A more reliable bank made trade easier, payments clearer, and confidence stronger. For business people, it could open the door to credit and expansion. For the colony, it helped create a more organized financial life. None of that means the system was equal or open to everyone in the same way. Banking power has always involved decisions about access. Who was trusted? Who received credit? Who could build from borrowed money? Who remained outside the circle? That tension was present from the beginning. The public face of the bank was confidence. The deeper structure was selection, record-keeping, and authority. Every bank has to decide whose promise is strong enough to become a loan, whose deposit is safe enough to hold, whose name belongs in the book, and whose risk is too large to accept. Those decisions may look technical. Over time, they help shape businesses, households, towns, and futures. In that sense, the first notes and ledgers were not minor details. They were the foundation of the bank's old institutional influence. The Bank of New South Wales became important because it made trust portable, recordable, and repeatable. It allowed confidence to move from person to person, from counter to counter, from Sydney's commercial streets into a wider colonial economy. The power was still young. It was still local. It had not yet spread across goldfields, regional towns, or later suburban branches. Even so, the pattern had been set. Once trust could be written down and accepted, it could travel. Once it could travel, it could grow. And when Australian wealth began moving beyond Sydney, The bank already had the tools to follow it. The goldfields turned a Sydney bank into a wider force. Trust does not stay powerful by remaining in one room. For the Bank of New South Wales, the first notes and ledgers gave the colony a way to record confidence. The next test came when Australian wealth began moving across the map. It no longer sat only in Sydney's commercial streets or inside the careful handwriting of early bank books. It was being dug from the ground, carried through rough roads, weighed, traded, guarded, and converted into new fortunes. After gold was discovered in 1851, the bank faced a different kind of opportunity. The goldfields did not only create miners. They created movement. People moved. Money moved. Merchants followed. Supplies had to be bought. Gold had to be valued. Payments had to be made. Value had to travel safely between camps, towns, ports, and city offices. A bank built on trust suddenly had a reason to spread. The Bank of New South Wales sent staff and gold buying agents to the goldfields in Victoria and New South Wales. That detail matters because it shows the institution moving toward Australian wealth as it was being created. It was not simply waiting behind a Sydney counter. It was placing its people and its records closer to the places where risk, opportunity, and new money were gathering. The goldfields were not gentle places for finance. A miner might find gold and need a secure way to turn it into usable value. A merchant might need credit to supply tools, food, clothing, tents, or equipment. A carrier might be moving goods through uncertain conditions. A town might grow almost overnight, then need services that had taken older settlements decades to build. In that world, trust had to move faster than tradition. The bank's work became practical. It helped connect gold, paper, records, and city markets. It allowed value found in one place to be recognized somewhere else. That is the quiet power of banking in a boom. The bank does not swing the pick or load the cart. It does not own every store on the road. Its power comes from making new wealth legible, portable, and acceptable. Within 10 years of that gold rush expansion, the bank grew from one Sydney office to 37 branches. That is one of the clearest proof points in the whole story. It shows how quickly a local institution could become something wider when the Australian economy gave it room to move. The expansion was not decorative. Every new branch meant another physical point where people could deposit, borrow, exchange, record, and trust. A branch gave banking a face. In a city, that might mean a counter and a manager in a respectable street. Near the goldfields, it meant financial order pushing into places shaped by rush, hunger, hope, and uncertainty. The signs of power were not always grand. Sometimes they were a desk, a book, a lockbox, a scale, a safe route, and a name people accepted when gold needed to become money. The old money structure deepened here. Earlier, the bank's authority came from its founding, its records, and its place inside Sydney's commercial establishment. The gold rushes gave that authority reach. It linked the institution to resource wealth without making the bank a mining company. The bank did not become powerful by owning the goldfields. It became more powerful by helping organize the money that came out of them. That distinction matters. Australia has many stories of old wealth built from what lay under the ground. This story is about the institution that followed that wealth, measured it, financed it, recorded it, and helped move it through the economy. Mining created visible fortunes. Banking turned those fortunes into deposits, loans, transfers, and wider commercial confidence. The resource boom gave the bank scale. The bank gave the boom a financial system that could stretch beyond the diggings. For the people living through it, the difference was not abstract. Miners needed buyers. Merchants needed working capital. Towns needed banks because trade without reliable finance could become chaos. Workers, carriers, shopkeepers, publicans, families, and suppliers all lived around the movement of money, even when they had no control over the decisions made in bank offices or colonial institutions. The bank's expansion also changed how Australians would come to recognise financial power. It was no longer only a Sydney institution tied to Macquarie Place and early colonial authority. It was becoming a network. A network has a different kind of strength. It can survive distance. It can collect information from many places. It can make one institution familiar across settlements that may otherwise feel separate. That is how a name begins to travel. The Bank of New South Wales grew because it was useful at the exact moment Australia's economy was widening. Its branches followed confidence into new regions. Its agents carried the institution's authority into places where gold had made life unstable and urgent. Its records helped turn sudden wealth into something that could be handled by a growing financial system. Expansion brought a deeper question. Once a bank moves beyond its original city, it no longer only serves a local commercial circle. It begins to sit inside the habits of more people, more towns, and more kinds of business. The bank that first helped organize colonial money was now learning how to become part of Australian life beyond the goldfields, not only where wealth was found, but where families saved, shops borrowed, and communities expected a bank to be there. How a bank became part of everyday Australian life. A bank becomes more powerful when people stop seeing it as distant. After the goldfields, the Bank of New South Wales was no longer only a Sydney institution following sudden wealth. Its reach had widened. Its branches had moved into new places. Its name had travelled with commerce, gold, merchants, and regional growth. The next stage was more intimate. The bank began moving from the world of trade and expansion into the ordinary routines of Australian life. That shift mattered because finance becomes different when it enters the household. A merchant using a bank to manage trade is one kind of relationship. A family using a bank to save for the future is another. A shopkeeper asking for credit, a farmer needing seasonal breathing room, a worker placing wages somewhere safe, a couple trying to buy a home. These connections made banking less like an institution above daily life and more like a system inside it. The bank's growth through the 20th century helped deepen that place. In 1927, the Bank of New South Wales merged with the Western Australian Bank. In 1931, it merged with the Australian Bank of Commerce. These moments should not be treated as a dry list of corporate steps. They show a pattern. The institution was expanding by absorbing other banking networks, widening its reach, and becoming less tied to one city or one colony's original commercial circle. Each merger meant more than a boardroom decision. It meant more customers under the same institutional roof, more branches connected to one banking system, more records, more deposits, more loans, and more towns where the bank's name carried authority. The people behind the counter did not control those decisions. The customers walking through the door did not design the strategy. Yet they were the ones who experienced the result in the ordinary rhythm of banking. A branch was never only a room with desks. In a town, it could signal that commerce had arrived. In a suburb, it could become part of a family's weekly errands. In a city, it added another layer to the streetscape of business, property, and respectability. The architecture of banking often worked quietly. Polished counters, heavy doors, signs above entrances, managers' offices, forms waiting to be filled, passbooks opened, signatures checked. Those details gave money a sense of order. For many Australians, the bank was where life's practical decisions met institutional judgment. The strongest move into everyday life came in 1956, when the Bank of New South Wales received a savings bank licence. That moment widened the bank's emotional territory. Savings banking brought the institution closer to households, not only businesses. It meant deposits connected to family security. It meant consumer loans for things people could picture clearly: cars, caravans, travel, housing, and the material signs of a life being built. That is where the story becomes more human. A loan is never just a number in a ledger for the person asking for it. It can mean a vehicle for work, a home to raise children in, a business that stays open, a holiday saved for over years, a step into a different kind of life. From the institution side, these were products and accounts. From the customer side, they were hopes measured against risk. The bank stood between ambition and permission. That word matters. Permission. A bank does not only store money. It decides whether confidence is strong enough to become credit. It decides whether a person, family, farmer, shopkeeper, or business looks reliable enough to support. Those decisions may be made through forms, policies, managers, and committees, yet their effects are felt in homes and main streets. Approval can create movement. Refusal can keep a plan fixed in place. This is how institutional old money became personal. It did not need a family name painted across a mansion gate. It sat behind counters and inside records. It grew through habit. People came to expect that the bank would be there, that savings would be held, that payments would clear, that loans might be possible, that the institution would endure longer than the uncertainty around it. That expectation gave the bank its public image. The image was not excitement. It was steadiness. A bank did not need to feel warm to feel necessary. It needed to feel dependable. In Australian towns and cities, dependability became its own kind of influence. The institution that held deposits and approved credit became part of how people imagined security, adulthood, business, property, and progress. There was skill behind that ordinary image. Clerks, tellers, typists, managers, and back-office staff kept the daily system moving. Their work was often repetitive, exacting, and easy to overlook. A customer might remember the sign above the door or the manager behind the desk. The deeper system depended on thousands of careful acts: checking, filing, recording, balancing, answering, approving, refusing. The people doing that work carried the public face of an institution whose larger direction was set above them. That separation matters. Ordinary bank staff were not the architects of mergers or national strategy. They were the human contact point between a large financial institution and the people who needed it. When a customer walked into a branch, they did not meet finance power in the abstract. They met a person across a counter, a form to complete, a question about income, a signature line, a decision that might change what happened next. By the mid-20th century, the Bank of New South Wales had become more than an old colonial bank with a long history. It had become part of everyday Australian expectation. People might not think about its origins when they opened an account or asked for a loan. They did not need to. That is how institutions become powerful. They move from being noticed to being assumed. Assumption brings its own danger. The more a bank becomes part of daily life, the more influence it holds without needing to announce it. Trust becomes routine. Routine becomes dependence. Dependence becomes a kind of quiet authority. The bank had moved from Sydney's early records, through goldfield expansion, into the savings habits and borrowing hopes of ordinary Australians. The next question was no longer whether people trusted it. The deeper question was what kind of power that trust had created, and what happens when a trusted institution becomes too important to ignore. The quiet power inside public trust. By the time a bank becomes part of everyday life, its power can look almost harmless. It does not need to shout. It does not need a smokestack, a mine entrance, a department store window, or a family crest carved above a doorway. It can sit quietly behind a counter, inside a passbook, beneath a signature, or inside a decision that tells someone yes, no, wait, or prove more. That is the kind of influence the Bank of New South Wales was building. Not the theatrical power of an empire on display, but the working power of an institution people had learned to rely on. Trust had become routine. That routine was the real achievement. A person walked into a branch because they expected the money to be there. A business kept an account because it expected the bank to clear payments. A family asked for a loan because it believed the institution had the authority to judge risk. A shopkeeper could plan around credit. A farmer could think beyond the next season. A town could treat the branch as part of the commercial landscape. None of that felt like old money in the usual sense. There was no single family line passing a private fortune from one generation to the next. The older power did not sit only in drawing rooms, estates, or portraits. It sat inside the structure of finance. It was built through deposits, lending, mortgages, business accounts, branch networks, and the public belief that the institution was stable enough to outlast individual uncertainty. That made it old money in institutional form, reputation accumulated over time, authority repeated through habit, influence protected by trust. A pastoral fortune could control land. A mining fortune could control access to ore. A media fortune could shape what people read or heard. A bank controlled something less visible and often more intimate: access to capital. It could decide whether a business expanded, whether a household borrowed, whether a farmer was supported through a difficult season, whether a person's future looked bankable on paper. That word carries weight. To be bankable is to be seen by an institution as worthy of confidence. It sounds technical, even ordinary. Underneath it sits a judgment about risk, income, assets, reputation, and future promise. For the customer, that judgment can feel deeply personal. For the bank, it becomes part of a system. Multiply that system across branches, towns, businesses, and households, and the quiet influence becomes enormous. The Bank of New South Wales did not need to command daily life to shape it. It only needed to become necessary. Necessity is a subtle form of power. When people depend on an institution for savings, loans, payments, and security, that institution gains weight in public life. It becomes part of the background of decisions. People may not admire it. They may not think about its history. They may only notice it when something goes wrong or when they need approval. Still, its presence frames what is possible. That is where public trust and private authority meet. The public image of a bank is calm, a place of order, counters, forms, safe records, and measured decisions. The business reality is sharper. A bank lends only when it believes the risk is acceptable. It expands where opportunity looks strong. It merges, reorganizes, and protects its own balance sheet. It can help build communities through credit and local service, while also deciding which ambitions remain outside the door. Those decisions were not made by the clerks or tellers who met customers face to face. Ordinary bank workers carried the daily burden of service, accuracy, and public confidence. They were the human surface of a much larger structure. The strategic choices sat higher up, with directors, executives, boards, and later corporate leadership. A serious telling has to keep that separation clear. The staff behind the counter were not the same as the institution that set the terms. For customers, the distinction was not always visible. They dealt with the person in front of them, the form in their hand, the account in the book, the answer they received. The human experience of banking happened at the counter, even when the real power came from the wider system behind it. That system grew stronger because it carried memory. A bank remembers in ways ordinary people cannot. It remembers payments, debts, deposits, securities, signatures, properties, guarantees, defaults, and promises. It keeps records long after a conversation ends. It turns a person's financial life into a file, an account, a history. In a growing country, that memory can become a kind of infrastructure. It lets money move across distance. It lets institutions assess risk. It lets one branch connect to another. It lets the name of the bank carry confidence beyond the room where the first promise was made. Here, the old money angle becomes clearer. The power was not only wealth. It was continuity. The Bank of New South Wales could point back to the early days of Australian banking. Its authority came partly from being old enough to seem permanent, familiar enough to be trusted, and useful enough to be difficult to avoid. Over time, that is how a financial institution becomes part of the establishment. Establishment power does not always look dramatic. It can look like being included in every serious conversation about money. It can look like being the place business people go before they build. It can look like a branch on the street that signals stability. It can look like a bank manager whose approval carries more force than encouragement from friends or family. It can look like an institution whose records matter because everyone agrees they matter. That agreement is fragile, even when it appears solid. Trust gives a bank its authority. It also creates the risk that the public image will one day be tested against the institution's private decisions, complexity, and scale. The larger the bank becomes, the harder it is to remain only the familiar local branch. The more people depend on it, the more each decision carries consequence beyond the boardroom. By then, the Bank of New South Wales had become more than an old name with deep roots. It had become a trusted mechanism inside Australian life. The question was no longer whether the institution had power. The question was how that power would change when the old identity itself was asked to become something broader, more modern, and less tied to the name that first gave it authority. The year the old name disappeared from the street. A name can vanish without an institution dying. For more than a century and a half, the Bank of New South Wales carried its origin in plain sight. The name itself pointed back to the place where the story began: Sydney, colonial finance, early records, branches, customers, and the authority of a bank that had grown with the country around it. It sounded old because it was old. It sounded local because it came from a colony before Australia became a nation. It carried memory every time it appeared above a branch door. Then, in 1982, that public identity changed. The Bank of New South Wales merged with the Commercial Bank of Australia and became Westpac Banking Corporation. The new name came from Western Pacific, a broader title for a broader institution. It looked outward, beyond the older state-based identity, toward a wider regional banking world. The change made sense from a corporate point of view. A bank with national reach and wider ambition no longer wanted to sound like it belonged only to New South Wales. For the institution, it was a transformation. For the old name, it was a quiet removal from everyday life. That distinction matters. The Bank of New South Wales was not shut down like a failed factory. Its doors did not simply close and leave an empty building behind. Its lineage continued through Westpac. Its records, history, customers, branches, and institutional memory did not disappear in one moment. What changed was the public face. The name that had carried colonial banking into modern Australia moved from the street into heritage. A sign can make history feel present. When people see a name every day, They do not need to study it to absorb its meaning. It becomes part of the landscape. Bank of New South Wales told a story every time it appeared in gold lettering, on paperwork, on a passbook, or above a counter. It reminded customers, even quietly, that they were dealing with an institution rooted in one of the oldest financial structures in the country. Westpac changed that feeling. The new name was shorter, modern, cleaner, and less tied to one place. It suited a corporate banking group stepping into a different era. It also softened the visible link to the old colonial bank. A customer could walk into a Westpac branch and use the same institution services without feeling the weight of 1817, Macquarie Place, early banknotes, goldfield agents, or the long accumulation of financial trust. That is how old power often survives. It does not always keep the same face. The public sees a rebrand. The institution keeps the deeper structure. Accounts continue. Records remain. Systems adapt. Staff keep serving customers. Customers keep depositing wages, applying for loans, running businesses, and making payments. The old identity becomes something held in archives, corporate histories, plaques, and memory, while the living institution carries on under a name built for the next stage. For ordinary Australians, the change may not have felt like a dramatic rupture. A bank customer usually cares first about access, security, service, and whether the money is safe. If the branch still opened, if the account still worked, if the loan still existed, the deeper historical shift could pass quietly. That quietness is exactly what makes the moment important. Some of the largest changes in institutional life do not announce themselves through ruins. They happen through paperwork, signage, letters, mergers, and new logos. The people behind the counters were not the architects of that change. Clerks, tellers, managers, and branch staff carried the new identity into daily contact with customers, while the decision itself belonged to corporate leadership, boards, and the larger banking structure. To the public, the staff remained the human face of the institution. To the institution, the name change marked a different kind of future. There was also a deeper shift in meaning. Bank of New South Wales sounded like an institution anchored in Australian beginnings. Westpac sounded like a bank of scale, reach, and corporate direction. The older name connected the institution to place. The newer name connected it to expansion. One carried the memory of a colony building financial order. The other suggested a modern banking group preparing for a more connected region and a more competitive financial world. Neither name was neutral. Names tell people how to understand power. A bank named after New South Wales feels rooted, historical, and local, even when it operates far beyond its original state. A bank named Westpac feels wider and more abstract. It belongs less to one street, one colony, or one early banking story. That abstraction is useful for growth. It also creates distance. The longer the new name stands, the easier it becomes for the older story to fade from public view. The old money structure did not vanish when the sign changed. It became harder to see. The deposits, loans, credit decisions, branch networks, records, and public confidence still mattered. The institution still carried the authority built across generations. Its age still gave it weight. Its history still shaped its reputation. Yet the everyday reminder of that history was no longer printed in the same way across the front of the bank. That is why 1982 is the central turning point of this documentary. Not because the bank failed. Not because the institution disappeared. The moment matters because it shows how Australian old power can transform without breaking. A colonial bank name became a corporate brand. A place-based identity became a regional ambition. A visible link to early Australian finance became a quieter inheritance. The story after that could not simply continue as before. A bank that had already moved from colonial records to goldfields, from branch counters to household finance, now had to live under a modern name built for a different age. The question changed again. If trust had survived the change of sign, how would it survive the next pressures? Speed, technology, scale, competition, and the growing distance between the bank people remembered and the institution it was becoming. Convenience, scale, and the cost of becoming modern. A modern bank does not become modern all at once. It changes through small adjustments that customers first experience as convenience. A machine outside a branch. A card at a counter. A screen replacing a form. A payment moving faster than paper could travel. Each change looks practical in the moment. Each one promises speed, reach, and efficiency. Taken together, They begin to change the relationship between a bank and the people who depend on it. Westpac entered that world carrying an older inheritance. The name had changed in 1982, yet the institution behind it still carried the weight of the Bank of New South Wales. That history gave the modern brand depth, even when the new public face looked cleaner and less tied to its colonial origin. Westpac had to do something difficult: preserve the authority of an old trust institution while becoming a bank built for a faster, more automated, more competitive financial age. The first signs of that shift were visible even before the new name fully settled into public life. In 1980, automatic teller machines began changing how customers accessed their money. A bank no longer had to be experienced only through a counter, a teller, a queue, or a manager's office. Money could be withdrawn through a machine, outside the older rhythm of branch hours and face-to-face service. That was a real convenience. It also changed the feeling of banking. A teller knew the sound of a customer's voice. A manager could become a familiar figure in a town or suburb. A branch counter carried the ritual of being seen, questioned, recognized, and served. A machine made banking faster, quieter, and less personal. For many customers, that was progress. For the institution, it meant scale could grow without every transaction needing the same human contact. Then came another shift. In 1984, EFTPOS arrived, moving the bank deeper into the everyday act of buying and selling. A payment could pass through a terminal instead of cash changing hands or a check being written. That made banking less tied to the branch and more embedded in the ordinary places where Australians spent money: shops, counters, service stations, supermarkets, small businesses, and local streets. The bank was no longer only where people went. It was becoming part of the transaction itself. That is an important change in financial power. A branch gives a bank a place. A card system gives it movement. Digital systems give it reach. The institution becomes present even when no one is standing inside one of its buildings. It follows the customer into the shop, the workplace, the household budget, the weekend errand, the business payment, the mortgage account checked at night. Convenience made the bank easier to use. It also made the bank harder to see. The old institutional power had once been visible in ledgers, counters, signs, records, and managers' offices. Modern power moved into networks, terminals, screens, databases, risk systems, and corporate decisions that ordinary customers rarely saw. The relationship became smoother on the surface and more complex underneath. That complexity kept growing. Westpac's later expansion through the 2008 merger with St. George showed another kind of modern scale. This was not the old Goldfield expansion, where branches followed new wealth across the map. It was consolidation inside a mature banking system. Familiar brands, customer bases, branch networks, and banking histories brought under a larger corporate structure. For customers, the result could feel ordinary. A sign still stood above a branch. Accounts still had to be managed. Loans still had to be paid. Cards still had to work. Yet behind the public face, the structure was becoming larger and more layered. Different names, systems, histories, customers, staff, and expectations had to be held together inside one banking group. Scale gives a bank strength. It also gives it weight. A larger bank can serve more customers, fund more activity, invest in technology, and spread its operations across more markets. It can become familiar in more places and harder to avoid. That is the attraction of consolidation. The same size that creates strength also brings pressure. More customers means more obligations. More systems means more ways for failure to matter. More brands means more histories to manage. More reach means more public scrutiny when trust is tested. The older Bank of New South Wales had built authority through continuity. Westpac had to maintain authority through complexity. That was a different challenge. A colonial bank could present trust through its name, its records, its branch, and its standing in the commercial world. A modern bank had to present trust through technology, compliance, risk controls, customer service, security, digital access, shareholder expectations, and national visibility. The promise stayed familiar. Your money is safe, your payments will move, your account will work, your loan will be managed. The machinery behind that promise became much harder for ordinary people to understand. For staff, the work also changed. Banking was no longer only ledgers, counters, forms, and local knowledge. It increasingly involved systems, processing, call centers, risk teams, compliance, software, remote decisions, and rules set far from the customer street. The people serving customers still carried the public face of trust. The larger structure around them became more distant and more technical. No single machine or merger explains the whole transformation. Automatic teller machines, FPOS, digital banking, brand consolidation, public listing, and corporate scale all formed part of the same movement. Westpac became more convenient, more modern, and more able to operate across a larger financial world. The price was a growing distance between the old image of local banking and the reality of a major corporate institution. That distance did not mean the bank had failed. It meant the meaning of trust had changed again. Trust was no longer only whether a branch manager knew your name or whether a ledger balanced at the end of the day. Trust now meant systems working invisibly, data moving safely, payments clearing instantly, brands integrating smoothly, and a large institution managing risks most customers would never see. The old name had already left the street. The older style of banking was now changing too. What remained was a powerful modern institution still built on confidence, yet operating at a scale where confidence had become harder to protect. And the larger that system became, the more serious the consequences would be when the public began asking whether trust was still being earned. When trust became harder to defend. Trust is easiest to claim when nothing has gone wrong. A bank can speak the language of stability for generations. It can point to its age, its branches, its customers, its records, its place in Australian life. It can remind people that it has survived wars, depressions, booms, downturns, new technology, new names, and new expectations. For an institution like Westpac, that long memory is part of the brand. It tells customers that the bank has been here before and will still be here tomorrow. Then modern pressure asks a harder question. Is trust still earned when the institution becomes too large, too complex, and too distant for ordinary people to understand? That question became sharper in 2020, when Westpac faced one of the most serious regulatory moments in its modern history. The federal court ordered the bank to pay a $1.3 billion civil penalty for breaches of anti-money laundering and counter-terrorism financing laws. The wording matters. This should be understood carefully as a civil penalty for serious compliance failures, not as a simple label for the entire history of the institution. Even with careful wording, the moment carried weight. For a bank built on public confidence, compliance is not a side issue. It is part of the promise. A customer may never read the laws behind the system. A small business owner may never think about risk controls. A family paying a mortgage may never see the internal machinery that monitors transactions, reports obligations, and manages legal responsibility. Yet all of that invisible machinery helps sustain the belief that the institution is safe, serious, and worthy of trust. When that machinery fails, the damage is not only financial. It reaches the older story. It presses against the image of the steady bank, the reliable branch, the institution that keeps records properly and handles money with discipline. The Bank of New South Wales had begun by turning trust into paper, ledgers, and formal authority. Westpac now had to defend trust in a world of digital systems, global flows, compliance rules, regulators, and public scrutiny. The scale that made the bank powerful also made the responsibility heavier. A small institution can fail in small ways. A major bank cannot. Every weakness becomes larger because the institution touches more people, more businesses, more accounts, more payments, more communities, and more public confidence. Modern banking power brings reach, and reach brings exposure. The larger the system, the more serious the consequences when the public begins to doubt whether the system is being managed properly. That is the harder side of institutional old money. Age gives authority. Continuity gives reputation. Size gives influence. None of those things excuse failure. In fact, they make the standard higher. An old trust institution cannot rely only on the memory of what it was. It has to prove, again and again, that the systems behind the familiar name deserve the confidence people place in them. Regulatory pressure was only one part of the modern trust question. Another pressure came from the physical presence of banking itself. For much of the 20th century, a branch was more than a service point. It was a public sign that a town, suburb, or commercial street was connected to the formal economy. A branch gave people somewhere to ask questions, deposit cash, manage accounts, seek help, and deal with money face to face. For older customers, small businesses, regional communities, and people less comfortable with digital systems, that physical presence could matter deeply. Across Australia, regional bank closures became serious enough to be examined through a Senate inquiry. The issue was not only whether banks could operate more efficiently. It was about access to cash, face-to-face service, local business needs, older residents, workers, and communities that do not experience banking as a simple app on a screen. For a major bank, those debates cut directly into the meaning of trust. A bank can say its services are modern and accessible. A customer in a regional town may ask whether access still feels real when the branch is gone or reduced. A bank can point to online systems and phone support. A small business that handles cash, an older customer who needs in-person help, or a community used to dealing with local staff may feel the change differently. Westpac's reported moratorium on regional branch closures until at least 2027 showed that physical banking still carried public and political importance. The commitment was not only about buildings. It was about the relationship between a major financial institution and the people who still need banking to have a local face. That relationship is fragile because it sits between two realities. From the corporate side, banks face cost pressures, digital migration, security demands, compliance systems, technology investment, shareholder expectations, and changing customer behavior. From the community side, the branch can represent something simpler and more immediate: access, reassurance, service, employment, and recognition. The tension forms when those realities no longer line up. The people inside branches often stand in the middle of that tension. Tellers, managers, customer service staff, and regional employees do not set national strategy. They do not decide the shape of the banking system from distant boardrooms. They are the people customers see when something does not work, when a loan feels uncertain, when a card fails, when a payment is delayed, when a branch changes hours, when trust becomes personal again. The public face of a large institution is carried by workers whose own position can also be affected by the same forces reshaping the industry. That is why the story cannot be told only from the top. Westpac's history is full of institutions, mergers, names, systems, and legal structures. The consequences of trust are lived much closer to the ground. They appear in a customer trying to keep a business moving, a family checking a mortgage, an older person wanting to speak to someone in person, a regional town measuring what it means when services move away from the street. The old Bank of New South Wales built confidence by being visible, formal, and reliable. Westpac inherited that expectation under modern conditions. The tools changed. The name changed. The scale changed. The demand did not. People still expected the bank to be safe, accurate, available, and accountable. That is the price of trust in a modern institution. It is not enough to have history. It is not enough to be familiar. A bank that grew from public confidence has to keep defending that confidence when its systems become complex, when its decisions affect communities, and when its failures become public. The longer the institution has stood, the more sharply people feel the gap between the promise of stability and the moments when that promise is tested. By this point, the story has moved far from the first rooms at Macquarie Place. The old name has left the street. The branch counter has given way to machines, cards, apps, and corporate systems. Still, pieces of the earlier bank remain, not only in records and plaques, but in the unresolved expectation that a financial institution should be worthy of the trust it asks from Australian life. What remains when an old bank becomes a memory? Some institutions disappear by closing their doors. Others disappear more quietly, by changing the name people see. The Bank of New South Wales belongs to the second kind of story. Its old identity no longer sits at the centre of Australian banking life in the way it once did. Most people now see Westpac, the branch sign, the card, the app, the mortgage statement, the corporate tower. The older name has moved into a different place. It survives in records, archives, old banknotes, plaques, histories, and the memory of buildings that once made banking feel physical and permanent. That is not the same as disappearance. Westpac remains an active Australian banking corporation. It still carries the institutional line that began in Sydney in 1817. Its shares trade under the code WBC, and its modern headquarters sit in Sydney, far from the rented rooms where the first bank began. The institution survived the change of name, the growth of technology, the pressure of scale, and the scrutiny that comes with modern finance. What changed was the way the old story is seen. The Bank of New South Wales now has to be found. It is no longer the everyday name above the counter. It is in the archival record, in old ledgers, charters, deeds, banknotes, correspondence, and shareholding papers. Those objects matter because they preserve the original machinery of trust. They show the bank not as a logo or marketing identity, but as a working system of promises, signatures, loans, deposits, and authority. A ledger is not an emotional object at first glance. Neither is a deed or a banknote behind glass. Yet these are the remains that fit this story. There is no ruined blast furnace, no empty assembly line, no final product rolling away from a factory gate. The remains of a bank are quieter. They are paper, records, names, account books, official seals, old addresses, and the traces of decisions made long before the modern customer ever opened an app. Macquarie Place still matters because it gives the story a beginning in the physical world. George Street matters because it shows the bank's early movement into a more established commercial life. These places should be handled carefully, with every building and marker verified before being shown as a visual. The emotional point is already strong enough without pretending a site is more intact than it is. The story does not need false ruins. It needs accurate memory. That memory is powerful because banking can become invisible when it works. People notice a bank when they need approval, when something fails, when a branch closes, when a payment is delayed, when trust feels uncertain. During ordinary days, banking often slips into the background. Wages arrive. Cards work. Accounts update. Loans continue. Businesses pay suppliers. Families budget around repayments. The institution becomes part of the rhythm of life precisely because people expect it to function. The Bank of New South Wales helped establish that expectation in an earlier Australia. Westpac inherited it under modern conditions. That inheritance is the old money legacy of the story. Not a family fortune passed through private houses. Not a pastoral estate held behind gates. Not a mining fortune visible in machinery and/or trains. The legacy here is institutional continuity, the ability of a financial name to survive across generations by becoming useful, trusted, and deeply embedded in daily life. There is strength in that kind of survival. There is also distance. The older bank was tied by name to New South Wales, to Sydney, to the beginning of formal Australian banking. Westpac is broader, cleaner, more corporate, less obviously historical. It carries the lineage without displaying the old origin at every moment. A person can bank with Westpac today and never think about Macquarie Place, early notes, Goldfield agents, or the first ledgers that made trust portable. That is how institutional memory thins. Not through one dramatic break, but through convenience, branding, and time. The people who carried the institution's public face also become part of that memory. Clerks, tellers, typists, managers, back-office workers, regional staff, call center workers, technology teams, and compliance workers all belong to different eras of the same larger system. They did not control the great decisions from above. They kept the daily relationship alive between the institution and the public. They were the voices, signatures, forms, counters, and later screens through which customers met a financial power much larger than any one person. Ordinary Australians felt that power in practical ways. A loan approved. A loan refused. A branch nearby. A branch farther away. A business account kept open. A mortgage paid over decades. A card working at a counter. A regional customer wanting a person across the desk instead of a system on the phone. What disappeared, then, was not the bank itself. The old public identity of the Bank of New South Wales disappeared from the street. The simpler image of local branch trust weakened as banking became faster, larger, more digital, and more complex. The name that once announced the institution's origin became something people had to seek out rather than something they passed in everyday life. What survived was just as important. Westpac survived. The records survived. The lineage survived. The idea of trust as the center of banking survived, even after that trust became harder to defend. The old power remained, not frozen in the past, but carried into new systems, new signs, new technologies, and new public expectations. That is the final weight of this story. Australian old money is not always visible in mansions, mines, estates, or family names. Sometimes it remains inside the institutions people use without thinking. It is in the record that outlives the people who signed it, the brand that outlives the older name, the archive that holds what the street has forgotten, and the banknote that still carries the first promise in paper form. The best ending is not a locked gate. It is an old document under light, a note, a ledger, a plaque, a name written carefully enough to survive. Beside it stands the modern institution that came after. The sign changed. The trust was tested. The memory moved into paper. And the power, quieter than before, remained. Perhaps the strongest ending is not a ruined building, but a document kept safe, a Bank of New South Wales note, a ledger, a name written carefully enough to outlive the street it came from. That is what Westpac inherited, a business and an older Australian habit of placing trust in an institution. Clerks, tellers, customers, families, shopkeepers, regional branches, and ordinary Australians all carried that trust in practical ways. The old name left everyday view, yet the records, the lineage, and the expectation of financial confidence survived across Australia. If your family remembers an old branch, a Bank of New South Wales sign, a Westpac story, or another Australian institution worth tracing, share it below. Like and subscribe for more serious Australian old money documentaries. Because sometimes power does not vanish. It stays inside the systems people use without thinking.